Someone is getting very, very rich right now. And every time you swipe your card at a gas pump, you're writing them a check. Today, we're going to find out exactly who that is and how a decision made in a room you've never heard of just added $1,200 to your annual expenses. Quick note before we dive in. Geopolitical situations change fast. This video explains economic mechanisms, cause and effect, supply chains, market logic. It is not a prediction about where prices go from here, and it is definitely not investment advice. Okay, let's build this thing. Picture this. It's a Tuesday morning. Sarah is a teacher in Columbus, Ohio. She earns $52,000 a year, slightly above the US median. She commutes 24 miles each way. She fills up twice a week. Last year, that fill-up cost her about $48. Today, it costs $67. That's an extra $19 every 2 days. Over a year, that's just over $2,400 more than she budgeted for, simply to get to work. Sarah didn't make a bad financial decision. She didn't miss a budget meeting. Something happened on the other side of the planet that reached through a complex chain of markets and policies and landed directly in her wallet. And here's what nobody explains well. It wasn't just one thing. It was a chain. And today, we're going to map every single link in that chain, from a tanker in the Strait of Hormuz all the way to Sarah's debit card. And the last link in that chain? It involves the Federal Reserve, and their response might actually make things worse before they get better. Let's start at the source: oil, specifically Middle Eastern oil. Iran sits on approximately 12% of the world's proven oil reserves. It's also the fourth largest oil producer in OPEC. But here's the problem. Iran and the United States have been locked in escalating tensions over Iran's nuclear program, sanctions enforcement, and regional proxy conflicts. In 2025 and into 2026, those tensions have translated into something markets hate above everything else: uncertainty. The Strait of Hormuz is a narrow waterway between Iran and Oman. Roughly 20% of global oil supply, including a large portion of what becomes U.S. gas, passes through it. When Iran makes threatening gestures toward that strait, or when U.S. sanctions tighten, global oil traders don't wait to see what happens. They price in the risk immediately.
So this is called a supply shock, not because supply has actually been cut, but because the market believes it might be. And in commodity markets, the belief is often as powerful as the reality. From January to March 2026, Brent crude, the global oil benchmark, climbed from around $78 per barrel to above $95. That's a 22% increase in under 3 months. Not because a single drop less oil was produced, because traders were scared. But here's what's interesting. OPEC actually had a chance to fix this. They chose not to. And when you understand why, the whole system looks very different. Enter OPEC, the Organization of the Petroleum Exporting Countries, and its extended alliance, OPEC+, which includes Russia. OPEC+ controls approximately 60% of global oil production. They don't just extract oil, they manage it. They set production quotas. They turn the supply tap up or down based on what serves their interests. In early 2026, as tensions with Iran escalated and prices began rising, global markets expected OPEC+ to pump more oil to stabilize prices and avoid a recession-triggering spike. OPEC+ refused. Saudi Arabia and Russia maintained existing production cuts, citing concerns about a demand slowdown in China. This is the part that matters. When oil producers restrict supply while geopolitical uncertainty is already shrinking the available pool, prices don't just rise, they accelerate. The fear premium on top of a real supply gap creates a double spike. And here's who benefits from that double spike: every oil-producing entity on the planet. OPEC member states, U.S. shale producers, oil majors like ExxonMobil, BP, Shell, Chevron. Their revenue goes up with every dollar crude climbs. Your gas bill is their profit margin. So the crude price feeds through to the pump. But how fast? And is the markup fair? The answer involves a number most people have never heard of, and it explains a lot about why your gas bill moves faster going up than coming down. Between a barrel of crude oil and a gallon of gas, there are several steps and several players taking a cut. Crude is extracted, shipped to a refinery, refined into gasoline, shipped again to a distribution hub, loaded onto tanker trucks, and finally delivered to your local gas station. Each step has a cost. Each step also has a margin.
There's a metric in the energy industry called the crack spread, the difference between the price of crude oil and the price of refined products like gasoline. When the crack spread widens, refiners make more money per barrel. In the first quarter of 2026, U.S. Gulf Coast crack spreads were elevated, meaning refiners were capturing a larger than usual margin on every gallon they produced. There's also a well-documented phenomenon called the rockets and feathers effect. When crude prices rise, gas prices at the pump respond quickly, like a rocket. When crude prices fall, pump prices come down slowly, like a feather. The asymmetry isn't illegal, but it does mean consumers absorb the full force of price spikes and only partially benefit from price drops. So crude rises, margins widen, and you pay. That feeds into something bigger than just your gas bill. It feeds into inflation. And once inflation enters the picture, the Federal Reserve gets involved. And that's where it gets complicated. Energy is not just a line item in your personal budget. It's an input cost for nearly every product and service in the economy. When gas prices rise, trucking costs rise. When trucking costs rise, the cost of delivering food, goods, and materials rises. When delivery costs rise, retailers pass them on. Suddenly, a gas price spike isn't just at the pump. It's in your grocery receipt, your Amazon delivery fee, your electricity bill. The CPI, the Consumer Price Index, which measures the average change in prices across a basket of goods, has historically shown that a 10% rise in energy prices contributes approximately 0.3 to 0.5 percentage points to headline inflation. The energy spike we've seen in early 2026 was closer to 20%. Do the math, and you're looking at a meaningful inflation contribution from this single event. For Sarah, our teacher from Columbus, this means her $2,400 gas bill increase isn't the end of it. Her groceries are up, her Amazon orders cost more to ship, her school's heating bill went up, which puts pressure on the district's budget. One barrel of crude touches every corner of her financial life. And when inflation rises, there's one institution that's constitutionally obligated to respond: the Federal Reserve. But here's the catch: the tools they use to fight inflation may create a different problem entirely. The Federal Reserve's primary mandate includes price stability. When inflation rises above its 2% target, the Fed's main tool is raising interest rates.
What happens to stocks, bonds, and savings accounts? So if stagflation risk rises, what does that mean for your investments? Specifically, what happens to stocks, bonds, and savings accounts when the Fed is fighting a battle it can't fully win? That's the final link in the chain. Let's talk about what this chain means for your portfolio, because the macro picture always, eventually, shows up in asset prices. First, equities. Rising interest rates generally hurt growth stocks, think tech, early-stage companies, because their future cash flows are discounted at a higher rate, reducing their present value. We've already seen this pattern in the 2022 rate hike cycle. If rates climb again in 2026, in response to energy-driven inflation, expect similar pressure on high-multiple stocks. Second, energy stocks. The flip side of the pain at the pump is extraordinary profitability for oil majors. ExxonMobil, Chevron, BP, Shell, their earnings rise when crude rises. Energy ETFs and individual oil company shares have historically outperformed during oil price spikes. This is not a recommendation, it's a mechanism to understand. Third, bonds. Rising rates cause existing bond prices to fall, because new bonds issued at higher rates make older, lower-rate bonds less attractive. This is a direct and mathematical relationship. For anyone holding long-duration bonds, a rate hike cycle is painful. Fourth, cash and savings. This is where higher rates actually help. For the first time in years, high-yield savings accounts and money market funds are offering meaningful returns. If the Fed pushes rates higher to combat energy-driven inflation, savers with cash earn more. It's a small silver lining in an otherwise uncomfortable economic picture. So the chain is complete, from a tanker in the Persian Gulf to your brokerage account. Now, what do you actually do with this information? Let's wrap up. Let's recap the chain we just built. Iran-US tensions create fear in oil markets. That fear, combined with OPEC Plus declining to increase supply, pushes crude prices up 20% in 3 months. The crude price spike feeds through refineries, trucking, and retail into a gas price consumers feel immediately. That gas spike adds 0.5 to 1 percentage point to headline CPI inflation. The Fed responds with rate hikes. Rate hikes pressure growth stocks, hurt bond values, and slow economic growth, while simultaneously benefiting cash holders and energy companies. One global event, one economic chain, every link connected. That's what Financial Arch is here to map for you.
Consumer credit cost. Higher interest rates make borrowing more expensive. Mortgages cost more. Business loans cost more. Consumer credit costs more. The intended effect: people spend less. Demand cools. Prices stabilize. The theory is sound. The execution has consequences. Here's the cruel irony. The gas price spike that triggered inflation was a supply-side shock, not a demand-side problem. People didn't suddenly decide to drive more. Supply, or the fear of a supply cut, pushed prices up. The Fed's rate hikes can cool demand, but they cannot drill a single barrel of oil or open the Strait of Hormuz. They're treating a supply problem with demand medicine. The result in a scenario where rate hikes are applied to a supply-driven inflation spike, the economy risks slowing growth without solving the underlying price issue. Economists call this stagflation, rising prices alongside a slowing economy. It's the worst of both worlds, and it's a real risk in 2026 if energy prices remain elevated and rate hikes continue.
If this kind of connected, engaging, system-level thinking is what you're curious looking for, excited, subscribe. I put out a new video every 2 weeks. And if you want this framework in text form, with charts, sources, and the key numbers, I break it down in the Financial Arch newsletter. The link is in the description. It's free, it takes about 10 minutes to read, and it goes deeper than any single video can. As always, this is not financial advice. Do your own research, talk to someone qualified, and I'll see you in the next one.